question for you. What do Ethics Week and Valentine's Day have in common? Well, Valentine's Day, where a person says, I love you, to another very special person. I'm going to do that with my wife. We've been married 51 years. I did the math today. That's more than 18,800 days. She's never thought of divorce, but murder crosses her mind about 2 or 3 times a week. Okay? That's a different ballgame. As a Catholic, if we divorce, she'd be back in church in 5 years. If she killed me today, she'd be back in church on Sunday, justified homicide. What about Ethics Week? We kind of do ethics here 24/7, but in this particular week, we get real explicit about it because it's a pretty important part of what we're all about. Well, here's a little answer of the week, okay? The answer is Bishop Oscar Romero, Everett Golson, or Malik Zaire, and the Ethics Week kickoff speaker. So Bishop Oscar Romero recently, the accounting folks, named him a Catholic martyr. Zaire or Golson, who's going to be the 2015 starter, okay? And then the Ethics Week kickoff speaker is Jerry Carter. But it's Monday, okay? Now Jerry's a 1988 Notre Dame alum. He majored in accounting. Somehow he got through even though he had me. Started his career with one of those big 6 or 8 or whatever it was at that time, big 8 at that time. After several years with Borg Warner, he moved to a company called IDEX Corp, which is an NYSE company. And right now he is the VP of Tax and International Finance. Let's welcome Jerry home with a round of applause.
Thanks, Ken. I have to tell you, it's a real privilege to be here today, to come back after many years and share the knowledge and experience that I've accumulated after graduating from this great university. The purpose today is not really to make you a transfer pricing expert by the end of the day, because that would take quite a long time. But the purpose really is to give you a feel for what transfer pricing is, why U.S. multinational companies need to know of transfer pricing, why various tax authorities around the world are concerned about transfer pricing, and then for you as an individual, someday you may end up working for a multinational company, and why it's important for you to be aware of transfer pricing as well. Even though you may not end up in a career in tax or accounting, you may end up maybe running one of the subsidiaries or one of the business units. And so hopefully you can gain that knowledge today. So what is transfer pricing? Transfer pricing is a set of rules that businesses have to deal with, and it concerns common ownership of companies and the transfer of their goods and services between each other or among each other at fair market value. Okay, so it doesn't apply to third-party transactions. So, a supplier and a purchasing company want to deal with each other and they're not related. It doesn't apply to those transactions. It only applies to what they call related party transactions or companies that are under common ownership. The rules vary by country. Every country has written their own laws and rules with respect to transfer pricing, various nuances, but in general, the theme is still the same, that it applies to companies with common ownership and you have to transfer goods and services at fair market value. So common ownership, it's a typically a 50% threshold. Again, this will vary, but it's typically a 50% threshold. So if you have a parent company that owns 2 companies that are at least both 50% owned, then they will be subject to these rules. It includes indirect ownership, and this is a black and white test. When you get into the transfer pricing audits and discussions, this generally is not where the subject of debate lies. The subject of debate really lies in the definition of fair market value. You'll also hear this called the arm's length price. It's really supposed to be what you would sell the same comparable product to a third-party customer. And so you need to really pick that price to sell to your affiliate. You can't sort of give them a friendly discount. It's a gray area because it's a wide range of interpretation. So if you're selling a product, you may not, let's say you have 10 customers, you may have 2 different prices. You may not charge the same price to the same customer because they might be, better negotiators of the price. They might be buying in higher volume, and therefore you might give them a bigger discount. There's lots of various reasons why you might charge a different price to different customers. So when you go to pick the price to sell to your affiliated company, you kind of get into this range of interpretation. When you go to pick the price, and you have this wide range of prices, and you're having a tough time picking one, the most conservative answer is to go right down the middle of the road, because you've got tax authorities on either side, and it's the only way to try and please sort of all the tax authorities all at the same time. So I'm going to give you a real-life example. IDEX is a $6 billion market cap company on the New York Stock Exchange. We buy a lot of other companies. It's a portfolio of manufacturing companies around the world. And we have a company that we bought that's in Lake Bluff, Illinois, that makes flow meters. And it meters, fluids, primarily gasoline. And so that's manufactured in Illinois. We bought another company that's in Italy, a nice place in Tuscany, that manufactures pumps that pumps gasoline. And so the Italian company thought it would be a good idea if we took the meter and the pump and we put it together on what they call a skid, and they sell it to European companies because we can add value by giving them the whole product all at once, and then all they have to do is install. This product may be like at a fuel pump at a marina, a large marina potentially. And so we have to deal with the transfer pricing in this situation because we've got 2 companies commonly owned by IDEX company and the corporation with the parent. They're both 100% owned. And we've got the sale of a good from one company to another. So in this situation, we have to worry about transfer pricing. So to put this into sort of similar numbers, I've got an example here that involves ND Corporation with 2 subsidiaries, Dillon and Alumni. The big red Dillon, that was my one. So as you've got the United States and Italy, let's assume that the tax rate is the same in both countries, 40%. We sell 100 of those meters at $80. So it's important to know on this slide where the red arrow is. So the sales that Dillon is going to recognize on this transaction is going to be $8,000. The 100 units at 80, and the corresponding cost to the Italian company, Alumni, is going to be $8,000. So there's parity there. And in this situation, the cost that Dillon has is $3,000. That's the cost to make the product, so they've got a profit of $5,000. Alumni is going to take this and sell it to the customer for $10,000. They're going to have a profit of $2,000. So the overall profit to the company is $4,200 after you apply the 40% tax. So if you were putting together your worldwide financial statements, this is the net profit that you would put together and show to the world. But let's say that I'm running Dillon, and my buddy who graduated with me way back when is running Alumni, and he's having a bad year. And Dillon is having a championship year, just like Dillon always has a championship year. And so I'm going to give him a discount because I want to help him out. And so the range of price that we normally have for this product is, say, $70 to $90 a unit. But I'm going to give him a discount, and I'm going to charge him $40. Okay. So now my profits go down because I'm only selling for $4,000. So now my profit at Dillon is only $1,000. But his profit jumps up to $6,000 because I've given him this $4,000 discount. But if you take a look at the overall profit of the company, it's still $4,200. And so you kind of look at this example as compared to the previous one, and you go, well, who really cares, right? I mean, I was just trying to help a buddy out. And the overall profit of the company is still the same. Our tax expense is still the same. So really, who would really be concerned with the fact that we've sort of shifted profits over to Italy? And the ones that would be concerned are the tax authorities. So the IRS here in the U.S. is going to see a reduction of our tax liability of $1,600. And I've used smaller numbers here to make the point, but you could very easily tack on another 3 zeros, or even sometimes another 6 zeros when you get into some large tax assessments. The tax in Italy has gone up by $1,600 because we've shifted profits over to Italy and they're going to pay more tax. Now, when you get audited, Italy isn't going to say a word. If they come in and audit your books and records and they see that this discount went through your books and records, most likely they're not going to say a word, and they're going to allow you to pay more tax. However, when the IRS comes in, they're going to start questioning you about your transfer pricing and how you pick that price, and they're going to want to see your documentation. And they're going to look at the range that you normally sell this product at and start questioning you as to why you sold this for $40. So the question is, would you consider that tax evasion? And I would have to answer that you would not consider that tax evasion, and let me explain why. You kind of look for intent, number one, and there was really no intent here to increase the global profits of the company. The global financial gain was zero. It was an honest mistake. Companies typically operate with a transfer pricing policy that employees within the company should be aware of. You know, you don't have to know it cold, but you should be aware that transfer pricing exists and that there is a policy out there that sort of governs, you know, what the internal prices are when you transfer between affiliates. And if you discover this situation, typically what you would do is you'd either amend your tax returns both in Italy and the United States, or if you're continually being audited, which some large companies are always being audited, then you would just wait for the audit to begin, and then you would tell the auditor about the mistake. And you know, the auditors are very comfortable with this. There's a 30-day period with the IRS that if you disclose your mistakes, there's no penalties, because they understand that, you know, in a large company that it's not possible really to file an absolutely perfect return when mistakes like this happen. And just as an aside, audits, U.S. versus Italy, when you get audited in the U.S., a large multinational, they typically just give you a call. So they'll call me and they'll say, you know, we're going to audit you for this year, and we'd like to set up an opening conference where we can talk about, you know, how we're going to go about auditing you and when. Italy, on the other hand, we've been audited a few times in Italy, and Italy doesn't make the phone call. It's sort of like a TV sitcom. They come in with police cars, and they show up at your manufacturing facility, and they get out, and they have their badges and their guns, and they come in, and they sit down at the business unit president's desk, they sit down at the finance person's desk, and they immediately start downloading files and your emails, and they scoop up all your records and everything. And it comes with no warning. And I've gotten phone calls from folks over in our Italian subsidiaries, and it's a very harrowing experience for them. And it's not like we've got any, you know, tax errors or tax mistakes. They just do this on a routine basis. So in this situation, I go back to the $80 per unit, but now we've shifted our jurisdiction to Ireland, and Ireland is known to have a low tax rate. It's actually 12.5%. I've used 10% in this example. And so what we've done here is we want to reduce our taxes, but we've decided that we're not happy with the Italian tax rate, so we take our manufacturing facility and we literally move it, and we move it to Ireland. So we build a new facility, we hire new employees and train the employees. We have Dylan ship the product to Alumni now in Ireland, and Alumni ships the product from Ireland to its customers in the EU. So what happens here? The transfer price is correct. You know, we think it is at $80, and so the profit before tax for the company is the same. However, now the tax for Alumni has been significantly reduced, right? Because they're not paying tax at 40% anymore. Now they're paying tax at 10%. So if you compare the net profit between Ireland and Italy at $4,800 with Italy and $4,200 with Ireland, you've got an increase of $600. So would you consider that tax evasion? And I would consider this is definitely not tax evasion. You know, there's an intent here to increase your global profits by reducing your tax expense, but you haven't done it frivolously. There was a business plan, there was a change in the business plan. You shifted your manufacturing facility to another country. And companies do this all the time. You may be unhappy with the labor rates in the country, you may be unhappy with the political stability in the country, or you may be unhappy with the tax rates, or all three. So you move production to another country. So the global financial gain, yeah, we earned $600 more because we lowered our taxes. But I think this is obvious. This is legitimate tax planning. You really won't get an argument from either country as to whether or not you didn't pick the right transfer price. You just changed your business plan, and so you did it with maybe the sole purpose of taking advantage of a lower tax rate. But that's good tax planning. So the next example is a company called U.S. Corporation, or USC, and they have two subsidiaries, and it's Carroll and Bush. May sound familiar. And they've been operating in Ireland for a while, and so ND Corp and USC have been neck and neck, for a while, competing with each other, and they're both sort of number one in their industry. But USC decides that they want to be the sole leader in our industry, and they want to have the largest profits. And so they arbitrarily lower their price to $40. When again, you go back to the range of prices, and it's 70 to 90. So if you compare what happens here, their profit shifts from U.S. to Ireland, and they're able to increase their bottom line by $1,200. Why? Because they lowered the transfer price. They're paying less tax. They have less profits in the United States, and they've now arbitrarily shifted their profits over to Ireland. And the question is, so here you have the increase in tax in the U.S. of $1,200, and they pay more tax in Ireland of $400. But since the tax rates aren't the same, you have an overall increase in your tax, overall decrease in your tax liability. So the question is that tax evasion? And I would say it's absolutely tax evasion, because you're being aggressive and you're starting to chip away at the range that you normally set your financial price. Your global financial gain was $1,200. You sort of took the easy way out. We took the hard way of actually shifting our manufacturing to another country. But they actually took the easy way out. They just arbitrarily lowered their price to see if they could get away with it. They have little or no supporting documentation. When you are in the transfer pricing world, you're required to support the price that you're selling to your affiliate at, and you do that through a lot of analysis and through a lot of comparables and supporting documentation that you would have sold that product to a third-party customer. So the question really is, other than wanting to be number one, why do companies sort of chisel away at their transfer pricing? And I've got a couple of examples. I'm sure there's more reasons, but I think the number one reason ends up being primarily greed. You're obviously able to increase your profits because you're shifting profits from one jurisdiction to another, and you're able to reduce your tax liability. Increased profits increases your earnings per share, and the earnings per share translates into a higher stock price. And if the individuals inside the company are holding the stock of the company or even stock options, that's going to increase their own personal net worth. Peer pressure. Sometimes inside of a company, a board or upper management, they're always tracking sort of the peer group of companies that are in your industry and as a comparable. And sometimes even compensation structures are set up based on your relative performance to these peer groups. And they take a look at the global tax rate of your peer companies, and they might see that your tax rate is higher. And they start asking questions as to why your tax rate might be higher than your competitors. And a lot of times it's based on where you're manufacturing. And so yielding to that pressure, sometimes people take shortcuts and they start to get aggressive with the transfer pricing. I mean, think about how easy it is if you already have this established relationship of selling products with an affiliate and how easy it is just to change the price. I mean, it really just takes a phone call, maybe, inside of an organization. They change the invoice, they change the price, they change the journal entries, and you've just shifted the profits from one jurisdiction to another with a phone call. It's pretty easy to do. Another reason why they like be aggressive with the transfer pricing is expiring tax attributes. You might have a tax loss carry forward that's expiring, because you can only carry them forward in many countries for a limited time. Same with tax credits. And so you might shift profits over to another jurisdiction so that you can soak up these tax loss carry forwards or these tax credits before they expire. Because if they expire, then you have to write them off and you have to expense them, which is going to decrease your overall profit. And sometimes it's patriotism, which really gets into some Japanese companies, really. So some landmark cases, Toyota Australia, which is kind of an example of that. You know, Japan's tax rate has historically been one of the highest in the world, like the United States. In Australia, is a little bit lower. Today it's about 30%, but Toyota Australia got caught shifting profits back to Japan and away from Australia, and the Australian tax authorities came in and they assessed them with a 250 million Australian dollar assessment. It involved a couple of years, but GSK also, this was the largest settlement in IRS history for transfer pricing, but their UK subsidiary overcharged the US subsidiary on some prescription drugs that they were shipping over, and it took a long time to settle this. This was a 17-year tax case. It went from 1989 all the way through to about 2005, 2006, and it ended up, GSK had to write a check to the IRS for $3.4 billion. So again, going back to my examples earlier, you can easily tack on multiple zeros to these assessments. FASB came out with something in 2007. I call it the FIN 48 guardrail. And financial interpretation number 48, and I won't get into the details of it, but basically they said, if you're taking aggressive tax positions in your tax returns, and you've been recording those benefits in your financials, if you don't think you have a more likely than not position, if you're more likely than not going to convince the tax authority that you can win that argument, then you are not entitled to record that tax benefit currently. You have to reverse it out. You can file your tax return the way it is. You have to reverse it out and put it on your financial statements as a contingent liability. So when you get back into the ranges of prices, you know, if you've got a range of price that you sell something at, and you're on the outer limits of that price, you're kind of getting away from the center of what you would normally charge somebody, and you're kind of getting into that gray area, and you're probably not as a more likely than not situation. The IRS then followed on that. The IRS came up with a form that you have to put in your tax return. Corporations have to include a form UTP, which is uncertain tax positions. And it's similar to FIN 48. And it's a simple form. You basically have to put in, you know, a concise description of what your issue might be, and you don't have to put in an amount. And same with FIN 48. You really don't have to disclose that, hey, I sold this product in Italy, I should have charged this price. You don't really have to tell all the details. And so you see the descriptions in the on the tax returns, and it might just mention a code section, or it might say a little bit more, and it definitely doesn't have an amount. So at least it gives the IRS an idea of that you have tax issues in your return, and this particular one. And then if they choose to audit you, then they know kind of where to look. And when U.S. multinational companies file this form, the number one uncertain tax position is actually the research and development credit, and transfer pricing is number two. I think there's a third. It's about 31% of the companies actually list transfer pricing as a potential issue on the tax return. So it's fairly high. This is what I've kind of come to call the cookie jar over the years, and it's a philosophy that some companies operate under, that if you never put your hand in the cookie jar, you're never going to get a cookie. So you might as well try. And what companies will do is they will take aggressive tax positions on their tax returns on a regular basis, knowingly. And they abide by the FIN 48 rules that we talked about before, and they'll reverse out the tax benefit on their financials and record it as a contingent liability and kind of cryptically disclose it. They'll also put it on their Schedule UTB on their tax return and tell the IRS that they have an issue as well. And then they'll wait. And they do this consistently year after year. And they wait to see if they're going to get audited. And if they do get audited, can they convince the auditor that they're correct? Or if they don't get audited, or even if they do and the auditor doesn't discover it, they wait for the statute of limitations to expire. Once the statute of limitations expires, as long as you're not fraud, then you can reverse that benefit and take it back into your P&L, reverse the contingent liability. And so companies do this on a regular basis. At IDEX, we don't subscribe to this at all. And the main reason is that if you can imagine, it's hit or miss, right? You end up with an inconsistent global tax rate. So if you've got reversals in some years and additions in some years, your tax rate ends up going like this, and your tax expense ends up going like this, and so do your profits. And when folks follow your stock, they're trying to predict what your stock price is going to be, and they can't because you've got this inconsistent global tax rate. So, you know, tax departments and upper management think that they're adding value sometimes to a company by doing this, but they might be saving some cash taxes, but many times they're not adding to shareholder value because you don't have a prediction of what your tax expense and what your tax rate is going to be over time. And the question really is this an unethical tax practice? You know, you're certainly presenting your financial statements to the world correctly. You know, you've abided by FIN 48, you reversed out the tax benefit when you should have, or you've taken it back in the income when you can't. And you disclose this on your tax return to the IRS to say, hey, I took this position, you know, come audit me. So it's certainly within the bounds of filing a tax return, certainly within the bounds of, you know, financial statement presentation, but, you know, kind of is it an ethical tax practice because you're kind of knowingly, you know, pushing the outer bounds of especially with respect to transfer pricing. And you may not have a very good supportable position. You may come up with documentation that does support what you're doing, but you know it might fall apart pretty quickly if something starts to harm you. Tax arbitration, we'll spend a little bit of time with. If you do get caught in a situation where you have a transfer price adjustment in one country, it's like baseball, you can go to arbitration and you bring the two countries together and you say, I have an income adjustment on one side, can I get the corresponding deduction on the other side to make my, you know, global profit be in parity. So the idea here is profit equalization. It's not tax equalization because you're going to, again, you're going to have different tax rates, but they'll attempt to, you know, equalize your profit. You'll still have interest and penalties on the income adjustment side. And in the U.S., it's called competent authority, and in Europe, it's called a mutual agreement procedure. The thing about Europe is that the European countries are forced to come to the table when the taxpayer brings this issue to them. U.S. competent authority, it's really governed by the tax treaties, and I'll bring up the U.S.-Italy tax treaty. Countries sign tax treaties, and one aspect of them is this arbitration. There's an arbitration paragraph. And the thing about U.S. and Italy, I'm sort of picking on Italy today, but the thing about Italy is that you can have an adjustment on the U.S. side that involves your subsidiary in Italy, but there's nothing forcing Italy to come to the table. And so if there's any country that we make sure that we have our transfer pricing documentation absolutely nailed down, it's when we have transfer to Italy, because if we get an adjustment on your side, Italy is not going to come to your tax arbitration meeting. And you're going to be left with a single-sided adjustment, and you'll end up paying a lot more tax. That's it. Advanced pricing agreements, if you have large transactions or large recurring transactions, you can bring the two countries together, present your facts, and say, you know, I want to get agreement on my price before I go forward with this because I don't want an audit adjustment later. They can be one-sided or two-sided, and they're guaranteed to the point that your facts stay the same. And this is the risk. You find out many times that you get an agreement with the two countries and with a set of facts, and then the business continues to run, and then somebody changes the business plan, and maybe you're not aware of it. And then you might get audited 4 years later, and for the first 2 years, your facts agreed. For the second 2 years, the facts might have totally changed, and the pricing probably should have changed as well. And so what they do is they'll void the APA on you because it wasn't what you had agreed to up front. There aren't very many of these in the U.S. There were only 145 back in 2013. The statistics aren't out yet on 2014. 75% of them involved an affiliate in either Japan or Canada. And it's very political as well. India, in prior years, hasn't been very taxpayer business friendly, and they've taken some aggressive tax positions against companies that are trying to, start up business, some large multinationals in India. And so these companies were trying to get advanced pricing agreements agreed to between the U.S. and India. And India was being really tough and kind of unfair. And the U.S. person who was negotiating these backed off a few years ago and said, we're not going to do anymore until this changes. And so a few years ago they had an election, they changed out the director of tax, for India, who then replaced the guy who was negotiating their APAs on the India side. And now it was just in the press just about a week ago that the U.S. has now agreed to come back to the table because now you sort of have a more reasonable person on the other side. And I think there's a backlog of over 200 advanced pricing agreements that are still on the table right now. And that was just in the press last week. So shifting profits can be good tax planning, in summary. If you shift your manufacturing and literally change your business plan and move it to a lower tax jurisdiction, that's perfectly fine. You're free to do that. It's hard work, especially when it involves a manufacturing facility. So what you're finding today is you're finding a lot of the transfer pricing cases and adjustments involve intangibles. And so what companies do is they sort of pull together their patents or their trademarks, and those things have value. And what they do is they move them to a lower tax jurisdiction, and then they start charging royalties out to the companies that are using that technology or using that trademark in their businesses, the affiliates. And so you end up with a tax deduction for royalties in a high tax jurisdiction and royalty income in a low tax jurisdiction. Now, when you talk about the transfer price of a physical good, like a chair, it's somewhat easier to come up with that transfer price than it would be when you're dealing with patents and trademarks. Because typically a company doesn't license out their patents and trademarks to their competitors or their suppliers. And so this is, and if you think how easy it is, going back to the physical plant movement, when you go and move intangibles, it's really more just legal paperwork. And you set up a shop with some employees in that low tax country to sort of manage this. But it ends up being really more about your legal fees in order to be able to do this. And this is where a lot of the transfer pricing cases are today. Amazon was just in the news with some shifting with some royalties with Canada. The cases are endless. And so it's really, when you get into that gray area of trying to determine your transfer price, this is where most companies today are pushing the edges or pushing the limits of their transfer prices. The IRS knew this, and so many years ago, they sort of put in a rule that said if you're going to transfer your intangibles offshore, we're going to catch you on when those intangibles leave shore and sort of impute a royalty and a tax and things like that. But this is really where the game has moved. So that's it from our transfer pricing presentation. So I'm just wondering if anybody has any questions. Well, hopefully you can see why if you were in a multinational company working, whether you were in the tax department, the accounting department, or whether you were out at a manufacturing facility, how this topic you would have to be aware of. You know, in tax, when I'm managing my group, I always tell them that, you know, 90% of solving tax issues is really being able to recognize them in the first place. You know, it's kind of like a conveyor belt of numbers that goes into your tax return. And if you don't have good quality control, those issues will go right off the belt and right into your tax return. And you won't find out until later, maybe, when you get audited. So that's why it's important just to get, just to be aware of these topics. You know, I don't ask folks to be transfer pricing experts in our organization. They can always call us. But it's important for them just to either recognize the fact that, hey, I might have an issue. Because I'd rather have them ask the question, even if it's not an issue, than not ask the question. Any questions?
One of the frameworks that the auditors use when they evaluate the control environment is the tone from the top, the management sensibilities. Do you have any specific or documented guidelines that you actually give to your employees related to things like transfer pricing? Don't ever play around with the prices during the quarterly.
Yeah, we have transfer pricing policies in place. They're more generalities, and everyone's supposed to be aware of them. We have onboarding meetings with new employees where we'll talk to them in general about transfer pricing. We also watch the profits of our individual subsidiaries on a quarterly basis, so we look at forecasts. And IDEX is the type of company, it's a great company, whereby every single one of our business units should be profitable. There's no reason not to be, because our margins are so high. And so we will look at the quarterly forecasts of these companies, and when we see one start to trickle down or even go negative, we're picking up the phone. Because 9 times out of 10, it's transfer pricing. It is. They might have had a special charge in the quarter or something like that, but 9 times out of 10, it's transfer pricing. And it's not because, you know, it's just because they didn't know. You know, they got pressure from somebody else and they decided to change the price. Yes?
The OECD is developing rules, regulations for tax against tax avoidance. Could you say something about what those rules are and if they are, maybe if they will be effective?
Yeah, so what's happened, give you a little bit of history here, is that, I'll go back a few years, I won't spend much time on that, but the IRS or U.S. Congress has usually, you've normally been on the forefront of putting these rules in place. So the transfer pricing rules, you know, the U.S. was one of the first countries to put the transfer pricing rules in place. And other countries thought, wow, that's a good idea, and they started putting the rules in place as well. And our Congress, as you probably know, has been a little stagnant for these many years, and there's not a lot of tax legislation that's coming out of our Congress. And so there's something called the OECD, and the OECD is a think tank that they focus on other things, but they focus on taxes, and they sort of analyze countries' tax base, you know, what their taxable income is made up of, or their tax rates. And they sort of put out these white papers and they say, hey, Ireland, you know, you should raise your tax rate, or hey, Italy, you should lower your tax rate. Or you shouldn't give people this special benefit. They attacked the U.S. on this, on an obtuse manufacturing deduction that people used to get, and they won. And so the OECD recently has sort of come to the forefront of changing tax legislation. And they have this project called what we call BEPS. And it's BEPS, and it's base erosion profit shifting. And they are really starting to uncover all of the tax strategies that multinational companies have put in place around the world, and in particular in Europe. And they're really starting to go after and publish white papers on these transactions. And the tax authorities sometimes weren't even aware that these transactions existed. And now all of a sudden you're getting this. There's like a bunch of white papers, a series of white papers that the OECD has come out with, and they said they're not going to finalize their conclusions until the end of 2015, I think it is. So a lot of the European countries are waiting. Spain sort of jumped out in front. UK passed some legislation at the end of last year. But a lot of them are, Germany was going to pass a lot, and then they decided to wait. But a lot of them are waiting for these final papers to come out at the end of 2015. And I think you're going to see a real wholesale change in tax legislation in Europe that is going to start to shut down a lot of the profit shifting that is going on. They're going after intercompany financing. They're going after the royalty deals. They're going after a lot of it. And to that end, Luxembourg has recently been in the news. So Luxembourg had there were some disgruntled employees out there, and they went and they copied a lot of documents that the Luxembourg company had, or the country had, and they put them out there. And it disclosed that a lot of multinational companies had cut special deals with Luxembourg. And they cut special tax rates. So sometimes it was 0, sometimes it was 5%. And the other side of the transaction was another European country. And the UK was another European country. When all of this got published, the EU, a lot of those countries got very upset. And they realized that they were being taken advantage of just because these companies were able to cut special deals with the country of Luxembourg. So now Luxembourg has backed off and started to put in these controls in place so that these special deals don't get cut anymore. So you're going to see over the next year or so the playing field really be leveled over in Europe. You don't find this a lot over in Asian countries because the Asian countries will penalize you heavily. So China, of course, communist country. It's better to have your facts in line there. Japan doesn't like aggressive tax planning. Korea doesn't like aggressive tax planning. And so multinational companies know not to sort of do their aggressive tax planning over in Asia. They picked on Australia for a while, and they were picking on, they were taking advantage of Europe for a while. But I think you're going to see the playing field level in Europe. And Australia went and really beefed up their transfer pricing team in recent years, and are going after, they're starting with the top companies, and they're heavily auditing the larger companies that are doing business in Australia. So yeah, that's a very, very current topic, right?
Jerry, who defines more likely than not?
That's a discussion you'll have with your auditors. You'll come up with your facts, and then you'll try and convince them that it's more likely than not. You don't take it. What folks used to try and interpret that as is, am I more likely than not to get audited? Sort of the audit ladder, and that's not what the test is. The test is, if you get audited, are you more likely than not to prevail with your argument? And so it's you kind of look at your, like I said before, you look at your transfer pricing ranges and the amount of facts. It's very subjective, and that's why you have a discussion with your Big Four auditor to determine whether or not something should be put up on the board again. So sometimes it's obvious, maybe it's a mistake that you made in your return, and other times it's not so obvious. So it's really a discussion with your auditor. Yes.
How do you think the U.S. government can unlock all the PREs that are held by U.S. limited entities, adding value back to the United States?
Or PREs?
Permanent reinvested earnings.
Oh, you mean the conversations about that currently?
Yeah.
Yeah. I mean, that's legitimate tax planning. And for IDEX, we take the position that our earnings are permanently reinvested outside the United States. And so the advantage of that is, for folks who may, just real briefly, is that if you bring your earnings back to the U.S., so let's say that Ireland example, you pay tax at 10% on all your profits. If you bring it back to the U.S., well, now you're going to pay tax at the 40% level. So you've just sort of like done away with all of your, good tax planning to shift your profits, to a lower tax jurisdiction. So what companies do in their financial statements is they take the position that, hey, I'm never going to bring my cash back to the United States, and therefore you don't have to book a future tax liability on those earnings because you say they're never going to get taxed in the U.S. And there's a lot of proposed legislation out there. I think President Obama actually proposed that there'd be a 19% tax rate. I think recently, if you bring in your cash back, and it's really a subject of it's a sore subject of debate, really. If you look at the European countries, the UK, the Netherlands, you look at Germany, you look at Italy, they all have tax laws that say if you're headquartered there, you can bring your cash back. In the UK and the Netherlands, you can bring your cash back without it being taxed. It's okay. In Germany and Italy, they'll tax it at 1.5%. And so the United States really is not at a competitive advantage, really, when it comes to U.S. multinationals trying to compete, say, with a company that's headquartered in Germany. The company headquartered in Germany doesn't have to worry about this at all. I mean, to the extent of 1.5% rather than 40. So most U.S. multinational companies take the position that their cash is never going to come back to the United States, and that's why you'll see a balance sheet of a multinational with a huge amount of debt, that they've taken out in the United States. But you'll also might see an equal amount or 2 times the amount of cash sitting on the balance sheet, sometimes 10 times. And it's because they don't want to. It's not beneficial from a P&L standpoint to bring the cash back, pay the taxes, and pay off the debt, especially with interest rates being as low as they are today. So yeah, that's a real subject of debate in Congress, and if they ever get around to passing, corporate tax reform, I think that would be at the forefront of what they pass. But it's really so you do extraneous things to move your cash around outside the United States to get in a position. We keep it outside the U.S. from a foreign exchange standpoint, so we buy a lot of companies. And we're looking at companies all over the world to buy. So we keep it in the local currency because we're going to use the local currency to buy some companies. So, you sort of have to come up with a use of the cash as well in order to make that representation. Yes?
With Ireland having such a low tax rate and other countries also competing for that, and the presence of multinational companies, do you think the countries have a right to compete with other countries to be a price leader and compete for more direct investment, or do they have an ethical responsibility to have sort of peer-reviewed tax rate?
Oh, good question. So the question is whether or not Ireland, and they've gotten pressure from the EU, right, for the low tax rate, whether or not it's fair to have countries should have lower tax rates than others. And Ireland was under attack because they had gotten so many benefits from the EU, and they were sort of in trouble. Their balance sheet was in trouble, really. And the EU thought they should increase their tax rate twofold. One, so they could repay their debt, but also because the other countries could be more competitive tax-wise with them. And Ireland stood up to the pressure and said no. And I guess I'm of the opinion that I think it's like companies. If you can run your company better than everybody else's, and you can watch your costs better than everybody else's, and you can charge, let's say, the same price as everybody else, you're going to get rewarded through higher profits. And so countries sort of have to, they adopt a similar philosophy, right? So you keep your costs contained, and you make sure you don't run into deficits, and you make your country attractive for business by, say, having an educated workforce, lots of other things as well. And so if you can make your income statement work without generating deficits with a low tax rate, then you win. I think, and then therefore you should be rewarded with additional business coming into your country, and people wanting to do business there. So it's sort of like, it's a competition. Those European countries are in competition with each other and other countries around the world. So And the U.S. has now, Japan's starting to lower their tax rate. So the U.S., when you combine it with the state corporate tax rates, has got arguably one of the highest in the world. And they're looking to lower that. I think there's been proposals out there to try and lower it down to about 28%, and take away some of the special deductions that, especially like manufacturing companies get, to lower their tax rate. So they would take away some of these special deductions, but then lower the tax rate for everyone else. So then you get into the pass-through arguments.
Take one more question. If not, let's close with a round of applause.